morning and good afternoon, depending on where you are connecting from. I'm Stefano Battilossi at University Carlos III, Madrid, and I'm very pleased to moderate this new session of the International Macro History online seminar. I'm very glad also to welcome today's speaker, Aditi Sahasrabuddhe. Aditi is assistant professor in political science at Brown University. She is an international political economist, and she works essentially at the intersection with geopolitics, global governance, the politics of international finance, central banking, and economic history. Her very recent book, Bankers' Trust: How Social Relations Avert Global Financial Collapse, published by Cornell University Press this year. And in this very interesting book, she navigates almost a century of written and oral sources, including correspondence among central bankers, and discuss how personal relationship help deal with the financial crisis central bankers had to deal with from the 1920s to the great financial crisis. So before I give the floor to Aditi, a quick reminder about the rules of engagement. The seminar will last 60 minutes. Aditi will talk for about 40 minutes. During her presentation, you can write down your questions and comments in the Q&A. In case of very short clarification question, I will briefly interrupt Aditi. Otherwise, she will respond to your questions in the remaining 20 minutes of discussion. And as usual, after the end of the formal session of 60 minutes, we will have an extra 15 minutes to continue our discussion in a more informal format. So, without any further delay, Aditi, the floor is yours.
Thank you so much for the introduction, and thank you all for joining. I'm just going to share my slides and get started. Sorry. Can everyone see okay? All right, I will jump in. So thank you again for joining me today and for this opportunity to present my work with you all. This is a newly published book, which is titled Bankers' Trust: How Social Relations Avert Global Financial Collapse. So as you all know, near the end of December 2007, the global economy was on the brink of a collapse in the supply of global money and credit. And this emerging crisis generated what economists have called one of the most notable examples of central bank cooperation in history. So as I'm sure you all know, what that looked like was between December 2007 and May of 2010, roughly, the Federal Reserve injected over $500 billion of liquidity into the global economy through these instruments called bilateral currency swaps. And what was especially unprecedented about this crisis is that, unlike previous, global systemic crises, this time even 4 emerging markets had access to these swap lines, with the exception of Mexico, which had received one before. Brazil, Singapore, and South Korea also got access to these arrangements. Now, looking back at the record of how central bankers were thinking about this role that they played, Bernanke talks about the experimentation behind a lot of these arrangements in his own book, where he says, "This may not work. I don't want to oversell it. If we do it, we're just going to have to give it a try and see what happens." And another central banker shared with me in an interview that early on in the crisis, we were swapping hundreds of billions of dollars overnight solely on our own word. In a similar vein, in another interview with Mervyn King, he shared with me that reciprocity and personal relationships matter fundamentally. If you trust your counterpart for temporary and emergency purposes, you can give the Fed a call. And looking to the role of how they were thinking about this experimentation and the role of sort of personal relationships and giving one another their word, this is not just something that comes up in conversations, in interviews after the crisis, but it's something that we can even see in the real-time discussions at the Federal Reserve in 2008, 9, 10. For example, at one point, Bernanke had to even interrupt his colleagues' Mother's Day celebrations in May of 2010 to tell them that yesterday, Jean-Claude Trichet called me and made what I would characterize as a personal appeal to reopen the swaps that we'd had before. And that morning, he'd gotten again personal calls from Mervyn King and Masaki Shirakawa, also asking the Fed to reopen the swap lines. Now, again, as I'm sure you all know, when countries face economic and financial crises, these are not the sort of first port of calls typically. Generally, countries would look to, unilateral policy adjustments. This could be interest rate adjustments, reserve withdrawals, domestic bailouts, and other forms of domestic policies. But also, this tends to come with quite significant distributional and opportunity costs and have tended to also be quite politically and economically costly down the line. In other cases, countries look to multilateral options such as loans from the International Monetary Fund, but these too can be quite politically and economically costly in terms of the stringent conditionality that's placed on these loans and the consequent loss of monetary sovereignty. And of course, I will note that during the GFC, countries used all of these instruments as well. But what was especially unprecedented was the bringing back of these swap lines, these bilateral swaps or historically credits, which allowed some central bankers to engage in rapid emergency financing across borders without these types of conditions. Now, when I look back to the historical record of global crisis management, I find that this use of bilateral credits is quite patchy. So we see extensive use of ad hoc arrangements between central bankers in the 1920s for some, but not for others. Similarly, we see the creation of the swap lines in the 1960s and 2008. But the Great Depression, for example, was something that did not benefit from this type of interbank cooperation. And so in the book, I asked the question, under what conditions and among whom are central banks most likely to cooperate using these ad hoc bilateral instruments? Now, moving away from this sort of typical economic literature, I'm actually looking to the sociologists for some insights to answer this broader historical pattern. And I advance what I call an individual and relational framework to understand how central bankers do their jobs to manage financial crises. I argue in the book that when leaders share these ties of interpersonal trust and goodwill amongst their colleagues at the international level, these sorts of arrangements are easier to arrange between bankers. And to make my argument theoretically, I draw on the work of economic sociologist Viviana Zelizer, who argues that people engage in the process of differentiating meaningful social relations and that they mark these boundaries by designating different types of economic transactions that they would deem appropriate to that relationship. And now, of course, she's looking at the role of familial, personal, and intimate ties. But in bankers' trust, I find and I show that these patterns are actually quite clearly apparent even at the global policy level. So in the book, I provide a comparative historical analysis of central bank cooperation, specifically with the look to these ad hoc arrangements in about the last century or so. And I point to both within and between case variation of these outcomes of extensive ad hoc arrangements between some banks during some sort of periods of instability and the overtime collapse, such as during the Great Depression, and even the within case variation of why some countries get these sorts of arrangements while others don't. And this is a qualitative analysis that looks to the historical record of how central bankers sort of made these arrangements. And so I provide a mix of sort of interview and archival evidence to make my case. I had the privilege to interview Ben Bernanke, Masaki Shirakawa, Mervyn King, Jean-Claude Trichet, many of their deputies, and then other central bankers who were in office during the 2008 crisis. And I also collected a lot of resources and evidence from the archives at the Bank for International Settlements, the Bank of England, Fraser, and other national and university archives, where I looked at the personal papers, correspondences, both formal and informal, and also the more sort of formal reports between central banks and within central banks of how they were putting together some of these crises arrangements. So in the rest of my talk, I'm going to first start with the theoretical argument, again, get you all on the same page and provide the insights that I advance in this book, in a more abstract way. And then I'm going to tell you a few stories from the interwar cases before I end with some broader theoretical conclusions and implications looking forward. So starting with the argument, when we think about this question and broader problem of international cooperation, Scholars across disciplines in economics and political science have given us a host of explanations that might help us understand these patterns. For example, Charles Kindleberger looks to the role of hegemonic stability and the role of one hegemonic provider of this public good of financial stability. Aiken Green, Lawrence Brose, and others have pointed to the role of domestic politics and interest groups that can essentially shape and curtail central banks' abilities and willingness to play this global role, and depending on what sort of institutional and domestic interests that they are faced with in response. Political scientists have also looked at the role of international organizations. So over the last many decades, countries have invested massive amounts of resources. This could be time, money, personnel, etc., to build international organizations to formalize and routinize international cooperation, essentially to prevent the ills of the interwar crises. And as we also know from the sort of economic sociology, political science literature, that a lot of these cooperative arrangements are upheld by a system of shared economic beliefs and epistemic consensus, such as sort of belief in the dominant ideology that would prescribe best practices to undertake specific types of arrangements. But again, as I mentioned, when I look at the overtime patterns, I find that a lot of this variation cannot be sort of unified under one explanation. And I'm not saying I necessarily do that entirely, but that's the attempt in this book. And I start at the point that a lot of these works assume motivational homogeneity about the actors in charge. And I think that they overlook the role of the people who interpret and realize the actions, the interests, and the goals of states that are facing these economic problems. And so in the rest of the talk and throughout the book, I provide a lot of explanations and narratives of how central bankers were able to sort of steer these patterns of cooperation during crises, and also how they sort of shape the institutional context in which they operate. For example, one former banker at the BIS once said in the 1960s that it is a close friendship, not the financial resources, that are the real strength of this institution. Different people could mean a different BIS. And so essentially what I try to show in this book is how these different people can shape the patterns of cooperation that central banks undertake. So starting again with the sort of bumper sticker of the book, when I argue that, I'm making an individual and relational explanation, the short argument of this book is that international cooperation of this kind is rooted in interpersonal cooperation, with the caveat that I'm focused on specific kinds of contexts of crises and radical uncertainty. And just to remind you of the argument again, I make the case in this book that when central bank leaders share these more interpersonal trust and goodwill relations, these sorts of ad hoc arrangements are easier to get off the ground. And in the absence of these relationships, countries will be more likely to have to face the costlier alternatives of more heavy-handed and costly unilateral or multilateral adjustment. Breaking down the role of individuals and relationships, I draw on the work from economics, economic history, as well as political science that points to how and when leaders have this sort of distinct role in shaping outcomes of economic policy making, and whether it's cooperation or dealing with other kinds of conflicts. So for example, Roma and Roma showed that leaders can matter in setting the disposition of the central bank that they lead. A Federal Reserve under different leadership has tended to prioritize different policy preferences and goals within the dual mandate. Friedman also makes the case that central bankers enjoy this heightened discretion in a crisis, again, which is a period that I'm focused on. And other scholars also point to the role of how leaders can actually foster relationships across borders that can facilitate interbank relationships and cooperation more generally. The relational aspect of this argument comes into the point that cooperation is not really at the hands of just one person. But when we look to cooperation during a crisis, we find that there's multiple leaders across different borders that enjoy this heightened discretion and have a greater influence in determining the sort of policy trajectory of their own institutions. And so I want to look into how these relationships between bankers can facilitate the types of outcomes that central banks undertake to manage financial crises. Again, to sort of draw out the theoretical roots of this argument, I look back to the sociologists who explained to us how trust and goodwill can facilitate this sort of cooperation and experimentation in different contexts. The first is that, sociologists have found that trust provides the affective basis for cooperation. It allows a lot of the initial difficult conversations to be broached between leaders that might know each other beyond their professional ties. And the security studies literature in political science also looks to the role of face-to-face diplomacy and how these sorts of relationships can help leaders go beyond the economic and policy obstacles that they might face in their interstate relationships. Then looking beyond, once these relationships have sort of been created, we also see work that shows that these personal bonds can facilitate some kind of risk taking between leaders, especially again in contexts that need a little bit more experimentation and new ideas. And this personal bond also helps facilitate and instill in the people a sense of obligation to them, not just undertake risky activity together, but to have the goal of honoring those agreements without the need of any third-party supervision. The last piece of the argument theoretically also looks to the role of changes in leadership. So again, in political science, there's papers and books that show that a change in leadership can actually instill trust or restore trust in a country after, say, some sort of civil conflict or crisis. And I sort of borrow this idea to bring it into the international monetary affairs space to see how changes in leaderships in a central bank can change or restore or even take away trust in the institution. I also want to set out a few scope conditions that both show the limits of the argument, but also how it stretches in different ways. The first is that this is an argument about crises and uncertainty, and this is where these interpersonal relations will matter the most. The reason for that is because crises themselves are sort of indication that system level trust and all the general routine operations of how the economy works has somewhat broken down. And when we have these leaders that have a heightened discretion, and if they share these ties of interpersonal trust, these trust networks can actually substitute the system level trust that has been eroded in a crisis. The second sort of scope condition is that this argument certainly operates more strongly at the margins. There's many countries that might be very small, weak, unstable, and even if their central bank leader is best friends with Jerome Powell, we can't guarantee that they'd be able to access a swap line from the Federal Reserve. They're just so far outside that economic scope of possibility. There's also many other cases in which cooperation is perhaps much less surprising or difficult to get off the ground, such as between G7 countries, like I talked about at the start of this talk. And so it's really at the middle ground where there's countries in which the economics and politics are a little bit more ambiguous as to whether they are inside this network or outside. And these personal relations can help facilitate and determine where these countries will lie in these broader networks. I also looked at the sources of these trust relationships. And of course, here, as well as in other aspects of cooperation, the more structural economic considerations will play a larger role. Institutions that are deeply engaged with one another provide leaders more avenues to meet and get to know each other and build these personal bonds. But we also know that, in many cases in our own professional lives, that even though we might meet someone very often, it doesn't mean that we develop a specifically close bond with them. We might even learn that they're harder to trust with that increased information. And finally, looking to how the argument stretches in different ways is even in contexts where cooperation is perhaps less surprising. I find that there's extensive use of personal and informal channels to make more ad hoc arrangements, even when institutions might have these more formal avenues available to them. So just to give you a sense of how I make this argument and identify it, I want to focus on the middle part of this table, which is that I looked at the role of the use of personal informal channels, private closed-door discussions, and the outcome of ad hoc arrangements, even in the presence or availability of institutional alternatives. And in terms of the evidence I look for, it's a combination of discursive interview accounts, personal and formal and informal correspondences, official records of decision-making, which I triangulate with the broader sort of reporting of these issues, the history that's been written about these crises, to make sure that, of course, I'm not biasing based on only what bankers have written or told me in interviews. The last part of the theoretical argument looks to the conditions that can even enable these sorts of agreements. The first is, of course, when we looked at the role of leaders, it's important that these leaders are seen to be influential within their own professional circles. And this goes beyond just their economic capabilities and the strength of the economy that they're dealing with. For example, Montague Norman wrote to Benjamin Strong in 1926 of Louis Frank, who was taking over the National Bank of Belgium, pointing to the fact that he saw him as a gentleman who speaks English beautifully, and even pointing out that he was Flemish instead of Latin, which is again looking more towards the role of identity and prestige and their character rather than just their economic capacity. At the same time, there's also interesting cases where we see some sort of trepidation between bank associates at a possible candidate for the governorship at the Bank of England in the 1960s, where people were concerned that he didn't really exude friendly relations and even described him as the dullest of dogs, a bum-faced purveyor of last year's platitudes. A second condition is that central bankers need to, or it helps when they share this identity of being above politics. We might think of this as modern day central bank independence, but the book points to this idea of independence and autonomy being a very important indicator of the trustworthiness of a bank and banker, even historically, with many instances, including the Reichsbank and the Bank of France, having a harder time getting credits because they were seen to have yielded to political influence. The last condition that helps these sorts of arrangements is the role of secrecy. And this is for many reasons. One is, of course, you want to avoid any kind of market reaction. But there's also this second idea that sometimes central bankers have to make politically difficult and sensitive decisions that may be, unappealing to the broader populace or difficult to broach with their counterparts. And so these sort of closed door environments will allow for these conversations. So we can see here that Bank of England associates even pointed to the role of this secrecy as being important, sharing that the ability of central banks to extend such credits promptly, flexibly, and secretly affords a unique and potentially highly effective instrument of international financial cooperation. So just to wrap up the theoretical section, again, I'm going to show you a few instances in which where central bank leaders share these ties of interpersonal trust, perhaps because of the shared identity of being above politics. They'll be more willing and likely to work together outside of the public view to make ad hoc arrangements to deal with their shared pressures. But in the absence of these ties, perhaps again because someone might have political experience, bankers will have to look to these more costly unilateral or multilateral options. So I'm now going to pivot to the economic history and look to a few stories from the interwar period. I should also emphasize that this just about scratches the surface of what's in the book. So I hope you have the chance to read it if you want more such stories. And I'm very happy to discuss this in Q&A as well. And before going into the specifics of these narratives, I want to point to how central bankers of the 1920s thought about this problem of cooperation in situations as such as one of instability, crisis, or even like taking on important policy goals such as currency stabilization near the end of the 1920s. So we have Benjamin Strong writing to Norman on this point of cooperation, saying, how can such a situation as the present one be met by any scheme or device, automatic or mechanical? And so they see this as something that cannot be institutionalized in such a routine way. Rather, it comes down to the point where people need to generally trust someone, and therefore resolves itself to the simple question, do they trust us? There's also an interesting sort of telegram that Schacht at the Reichsbank sent to Strong in New York after the Doors program, where he wrote, may people more and more realize how largely personal contact, knowledge, and friendship are bound to foster such a development of the good of all. So I want to start with the story of the creation of the Gold Discount Bank and the Doors loan to Germany. But before that, I want to give you a little bit more background in case this is not familiar to you all, which is after the First World War in the Genoa meetings in 1922, Montague Norman was tasked with the role of sort of convening the world's, European central bankers to deal with the economic problems following the war and of reparations, etc., between countries. But instead of building some sort of committee or more formal institution to do so, Norman, along with Strong, always preferred to take a more ad hoc, informal approach to select who they wanted to include in these meetings so that they were not open to any kind of public scrutiny. Émile Moreau, who was the governor of the Bank of France, was often left out after 1926, was often left out of these arrangements, and he has a famously petulant ongoing feud with Norman at this time, where he even wrote in his book later on that the order in which invitations were extended were at the very least undiplomatic. And Bank of England associates also sort of recognized this later on about Norman, saying that he picked people who were congenial to him and blind to the talents of those not congenial. One person who was famously congenial to Norman was Hjalmar Schacht, who took over the Reichsbank in 1924, and it was announced that he would be doing so near the end of 1923. And they had this infamous first meeting in London on New Year's Eve and New Year's Day, that at the turn of that year, in which they had always wanted to meet one another. They shared this idea of prestige and they shared disdain of what they described as the vulgar masses. And very quickly, they were able to build this very close personal friendship, even to the point where in their very first meeting, Norman agreed to a loan to the Reichsbank of $25 million. This allowed for Schacht to create the gold discount bank and deal with Germany's hyperinflationary problems, and also then set him up for bringing in the American bankers later on in the decade in the floating of the doors loan. Most interestingly here, this is when we see Norman communicate with Strong about his view of Schacht, and as he pitched it to him to bring him on board for the negotiations, saying that Schacht seemed to know the whole situation from A to Z and to have temporarily more control of it than I believe possible. He's acting more resolutely than his predecessor, Havenstein. Now, Havenstein had repeatedly tried to get some sort of loan from the US or the Bank of England, but he was seen to have been pressed by the domination of the political authorities, and in Strong's word, also didn't understand the technique it required to build more personal relationships that was seen to be more sympathetic between bankers in their central banks. And so, because of this lack of prestige, this sort of put a lot of trepidation in the minds of central bankers early on in the decade and all throughout those years of hyperinflation, with Strong at one point describing Havenstein to Norman as someone who presents a sad picture of an old man, heartbroken and disappointed, and apparently helpless in the face of events. I'd been told he's the most reliable and conscientious banker, but that he's lost his prestige in Germany because of the failure of the Reichsbank to withstand the pressure of political domination. And what's really interesting is despite, continued efforts to secure a loan up until the end of 1923, Havenstein repeatedly failed, whereas just a month later, at the end of the year, Schacht was able to, secure a pretty large loan from Norman on their very first meeting. And this is essentially in response to Havenstein's sudden death that year when Schacht was slated to take over. The changes in the leadership of the Reichsbank certainly changed to a great deal Germany's fortunes in accessing external finance. Another story that I talk about in this book is Britain's return to its pre-war parity of $4.86 for an ounce of gold. And at the end of the war, the Cunliffe Committee had been created with a plan and a timeline of how this was going to be executed, with the government intervening on whether or not they wanted any kind of domestic rate adjustments. They really did not want any kind of external credit. Norman had different ideas on how this was should be executed. And given the disagreement between the bank, the government, Keynes, and Norman, he was able to, using his sideline conversations with strong arm the process of how Britain returned to gold, and essentially use this personal relation to obfuscate a lot of Britain's own gold resources. Instead of taking the channels and the timeline that the government preferred, Norman always chose to make arrangements with Strong face to face in the spirit of friendship and avoid any public discussion in this way. Instead, the two of them would repeatedly get together and devise a plan which would probably include some sort of credit operation. And a few years later, this was a credit of up to $300 million from the New York Fed to the Bank of England that allowed Norman to essentially obfuscate Britain's gold losses and, essentially cook the books on gold holdings domestically, that allowed him to return to gold at the rate and the pace that he wanted to, going against the preferences of the government. And throughout these conversations on how they wanted to engineer this goal, Norman would also emphasize to Strong of how secretly this issue must be treated, so much so that not a word can be breathed until some decision must be reached. What strikes me in this infamously famous relationship between Norman and Strong is not just how they worked with one another, but their fear of the possibility of having to work with someone else if one of them were to leave office. In fact, early on in their shared tenure, Strong even wrote to Norman saying, "Success in accomplishing anything depends so much on these personal relations that I look forward with dread to the day when you will be succeeded by some unknown person with whom I may not have the same intimate and affectionate relations with that I've enjoyed so greatly with you." And so this is a really important example of central bankers thinking about the leaders in charge across borders and who they are interacting and how that shaped their willingness or ability to go more than halfway to work with one another. And in this case, Strong's relationship with Norman was really important for Norman as well. While he was seen to be one of the world's most powerful central bankers, given London's global economic position at the time, he was also seen to be a bully on the continent, someone who sort of exerted Britain's imperial tendencies on European central banks. And despite his friendly relations with Schacht, Strong, and Inouye in Japan, most European central bankers had a lot more pause when it came to working with Norman. And so that his ties with Strong were a very important conduit for additional trust for them to enter Norman's various arrangements and facilitate different type of ad hoc credits to countries that were seeking currency stabilization throughout the decade. But as France gained its economic power and stabilized the franc in 1926, Strong found it important that Emile Moreau was now also included in these additional loans that were floated to Eastern European countries, which Norman refused to work with. And so Strong found himself in the role of a mediator between the two to try to get them, specifically Norman, to reconcile on his position in order to float various credits to Eastern European central banks. Strong even once confided to Moreau, saying if Norman fails to reach a reasonable and pacific frame of mind, that he would have to use his own methods if necessary to get certain members of the court of the bank to stand up for a policy of conciliation. But for Norman, this sort of agreement was impossible, and developing friendlier relations with Moreau involved more questions of personal equation than of institutional relationships, that Norman was so sensitive that anything of the sort might prove fatal. And in the end, a lot of these currency stabilization loans that were provided to Eastern European countries ended up being a lot more politically charged, involving quite significant political concessions that were ultimately given to France, and involved the League of Nations rather than any sort of ad hoc arrangement from central banks to provide them with lower cost loans, because Norman essentially refused to work or reconcile with Moreau throughout this process. But not long after this last letter was written, this report was written in Strong's own papers, Strong died quite suddenly in October 1928. And with that, Norman lost a very important conduit of his trusting and better relationships with European bankers. And this is at the eve of the Great Depression and the stock market crisis of 1929, with Norman finding, as his biographer writes, that he was desolate and lonesome at Ben's sudden death. I also talk about many other cases in which, these sorts of cooperative arrangements start to break down as Norman finds himself increasingly working on his own and doesn't have the same sorts of relationships with his counterpart, George Harrison, who'd taken over from Strong. But in this talk, I want to focus on the Luther conquest for $1 billion, which was the largest loan of the time during the Great Depression, because I've talked already a little bit about Germany so far. And during this crisis, and of course, the rest of the world is also underwater at this point, Luther had sought an Anglo-American loan that through the international committee that Norman had created. But because Norman and Harrison didn't have the same sort of communication and cooperative arrangement that Norman had had with Strong, most bankers in both countries didn't really know who was involved in these programs or what was needed, that most of these loans were never adequate and essentially failed to meet Germany's problems. And so instead, we see that Hans Luther, who's now taken over the Reichsbank from Schacht, had to take the first most desperate act, a conspicuously desperate act by a central banker, in which he boarded a plane to Amsterdam and then to Paris, looking for money from other central banks. And during his time in Paris, he visited essentially all the regions of the Bank of France, but specifically not Clément Mouret, who had now taken over the Bank of France, looking for a larger loan from the French, who at this point in a better position to provide any support. But the French wanted more conciliation and the ending of a customs union with Austria, and to sort of prevent the rise of the Nazi Party. But these are all things that Hans Luther had no control over domestically, and was unable to ultimately secure this loan. But later on, Murray sort of expressed to Bank of England associates his surprise and wonderment of why Luther didn't actually come directly to him for a loan, which Luther's response was for fear of snub. And so he didn't have the right relations with Murray to even broach this initial conversation to see if the Bank of France could provide some sort of bilateral credit. Instead, what the central bank community at this time was pointing to was rather that Luther was really not the person who should have been in charge of this crisis, with Norman even expressing to Harrison at one point that there was a need for more financial brutality in both Germany and Austria, and that to this end, Schacht was the right type. And even in the newly created Bank for International Settlements at Basel, it was becoming more and more clear amongst bankers that Schacht we might actually return to the Reichsbank. And this would lead to a conflict between him and Luther. Schacht would come out on top and eventually become financial dictator. From Paris, Luther went on to Basel to see if he could secure a loan from there. But at this point, Harrison was not able to formally participate in what was going on at the BIS. Norman was fairly checked out, and most central bankers didn't trust that Luther had any kind of credible program and found that he was quite helpless during these meetings, that he had to leave Basel that day with essentially no loan. And so Germany's crisis, along with the rest of the continent, just continued for a few more years. Of course, like I said, there's many other things going on at this time, but I want to jump to a couple of years later when there was a sort of last-ditch effort to get central bankers in the same room to negotiate some kind of arrangement now that many countries had suspended gold convertibility or left the gold standard. And so the tripartite central bank meetings were being held in parallel to the World Economic Conference meeting in 1933 in London. But most interestingly for me is none of these central bankers were both able or willing to actually contribute much to these discussions. Harrison was very much constrained at home by the board in Washington. Norman believed that not a thing could be achieved in these London meetings. And while Murray found the need for some sort of cooperative arrangement, none of them could sort of reconcile on what could be done. And these meetings were ultimately dashed by Roosevelt, who made a statement about the dollar and gold convertibility that ended these tripartite meetings and the WEC in utter failure. But what struck me as really interesting at this point is near the end of that year, Luther was now replaced by Schacht again at the Reichsbank. And this is when the initial conversation between London and Germany began for the standstill arrangements that allowed Germany to pause some of its debt payments to Europe from the First World War reparations. And, this context is really important because this is something that was very difficult for Luther to do with Norman in a way that Schacht could. And after these conversations were started, Schacht wrote to Norman saying, we're going to have to go through some more dark waters, but I feel more strongly that after the death of our New York friend, you and I have been the only two men who understood what had to be achieved. And so, essentially the two of them found it important to work together on their collective terms to deal with the crisis moving forward. And as you all probably know, this also led to an even more infamous relationship between Schacht and Norman throughout the Second World War, which I think is a book on its own, which is why I don't talk about it in this. But I think it again shows how interbank relationships and central bankers' relationships can actually supersede a lot of the political ties between countries for bankers to deal with economic problems in the way that they choose. So to conclude, I also want to emphasize, just like in the Eastern European cases where countries were subject to quite costly political conditionality and concessions to France and the League of Nations, this is not unlike a lot of the denials of swap lines to emerging markets that were following requests in 2008 and later on in the decade during the taper tantrums. And so while this might seem like a story of central bankers really garnering a lot of their power and capacity to secure and rescue the global economy, which is a very important role that I think they should continue to play, it's certainly one that's quite unequal. And so one of the main implications of this book is while we rely extensively on central bank leaders, that this system of managed fragility in the hands of just a few people both creates and exacerbates existing economic hierarchies and in an already uneven playing field. And essentially, access to this kind of attractive financing, the lower cost bilateral ad hoc credits and swaps, are inequitable and networked. Related to this is this sort of problem that this raises on the politics of technocratic governance, which I think in this book I find is nowhere as automatic or as apolitical as has been established in a lot of the discourse. Now, a lot of this discourse has been focused on the sort of domestic tensions with democratic principles. But I try to find a different angle to this problem, or I point to a different angle on this problem, which is now we're becoming increasingly reliant on domestic unelected agencies that have an unmatched power, especially when we think of the Federal Reserve, to manage global governance. And again, this raises a lot of questions given this is an inordinate power that's being delegated to these unelected actors by countries that have not actually delegated them to in the way that they might have done to, say, the International Monetary Fund. Most interestingly to me is that this is something that even Fed officials have recognized, with Don Cohen, the former vice chair of the Federal Reserve, the FOMC, saying that the swap lines put the FOMC in the uncomfortable position of being an arbiter of the soundness of other countries' policies, the liquidity requirements of their banks, and their systemic importance. And again, this is pointing to a domestic agency playing this very important global role that is seen as, by many countries, not something that they signed up for. And the last implication of this book is more scholarly, which is that I think, and I hope I show, that we need more studies on the role of leaders and individuals in managing international monetary affairs more generally, specifically in the context of monetary governance, as we return to a more uncertain and isolationist world. So the book shows that, as we know already, crises enhance the distinct role of individuals and leaders, and how their personal relationships are established and how they function can actually shape global outcomes of cooperation or crisis. And so in this system of managed fragility, personality and policy are inextricably intertwined. And this too is something that Fed officials considered during the 2008 crisis, when they talked about the need for establishing a more standing arrangement, which they ended up doing in 2013. Because as Nathan Sheets described, 10 years from now, the folks in New York who did all the work may be onto other things or another position. And so if there were another crisis, the Fed at the time would have to run around and figure those things out from scratch, which is, again, time-consuming and costly and cannot be guaranteed with different people in charge. And we actually saw an example of this exact concern when in March 2020, it became very clear that the global economy was going to need some sort of massive liquidity injection. And experts were calling on the Fed to dust off its crisis playbook and bring back the swap lines. And what struck me in all of this reporting at the time was Gillian Tett at the Financial Times even wrote that while Jerome Powell had been forging collaborative relationships with his international counterparts, they had not been battle tested yet. And so this is a concern not just about who's in charge, but whether they have the capacity to play this role with their international partners is something that the broader community has also considered and was a source of some concern until the swap lines were redeployed in March 2020. And I want to end on that point specifically because, as you all know, Powell's term is coming to an end next year. And again, when we see a more isolationist government that's going to look for people who are not as attuned to the Fed's global responsibilities, for lack of better word, this raises new questions for the capability, not just the ability, but the willingness of the Fed and other central bankers to play this critical role in future crises. So I'm going to stop here and want to share a really fun archival find for a concluding slide, but I'm looking forward to a discussion with you all. Thank you.
Thank you very much, Aditi, for this fascinating talk. While we gave a couple of minutes for questions and comments to flow into the Q&A, just allow me to use my privilege as a host to kick off a little bit of discussion. So at the very beginnings of the book, you quote a letter of Norman to Strong in 1926, I think, on the stabilization of the Belgian franc. In this letter, Norman praises the new governor of the Belgian Central Bank, Louis Frank, who had just replaced Fernando Ten, saying he is Flemish, not Latin. So this reminded me this famous passage by Walter Bagehot in his pamphlet Universal Money of the 1860s, where he talks about Teutonic versus Latin money, the commercial vigor of the Teutonic races versus the comparative torpor of the Latin races. So in different passages in the book, you also show the exclusion of French central bankers from in the inner circle of Norman and Strong, and a more general lack of trust or difficult communication with the Bank of France. So the question is, having gone through this century of correspondence among central bank elites, did you perceive the existence of such sort of deeper cultural issue about Latinity, right? And its impact on how money is managed or how central bank interact with politics. So is culture driving, shaping, or mediating personal affinities among, for example, Anglo-Saxon bankers, including the Germans, right? So, and if so, did you perceive that this issue with Latinity became less an issue over time? So, in a sense, this cultural problem went gradually diluted over the course of the century.
That's a great question. And it's something I thought about a lot. And so in the 1920s case, this certainly is something that comes up a lot. I think Norman in particular had a real Anglo-Saxon bias, and how those communities would be formed was certainly, that was a part of it. It was not always central, but it was applied quite heavily to the French and the Belgians especially. And I think this is something that changes substantially even by the 60s, because again, the post-war context is also so different. But what struck me is that even in some of the interviews that I did for the 2008 crisis, people said that, it's not really so much about the cultural issue of Latinity and how they think about economics necessarily, but that even now, a lot of those cultural ties might be facilitating, stronger affinity between Anglo-Saxon bankers than it does with the more Latin Europeans. So it wouldn't be like a main cause at all, but it's certainly something that does increase the chances of these personal relations taking place, especially again in contexts where you have people like Norman, where identity and prestige are so intertwined in his mind.
Mm-hmm. There is a question in the Q&A from Robert Macaulay. Robert, I will unmute you to allow you to ask the question directly.
Thank you. I'd certainly like to associate myself with the last remarks by Aditi, the concern for the de facto existence of the swaps at the present time and looking forward in the coming months. I've called for a dollar coalition of the willing, pool dollars in the possible absence of the Fed. But to go back to 1931, having worked with the BIS for 25 years, I accept the thesis that personal relations are important. But interpersonal trust may be necessary, but not sufficient. If I heard right, there was a claim that 1931 did not benefit from central bank swaps. But Kindleberger in Manias, Panics, and Crashes, pages 301, 303 in the 8th edition, described how there were central bank swaps to both the Austrian Central Bank and the Reichsbank then. But the problem was not that they weren't there, but that there were political constraints imposed by the Banque de France and on the part of the Bank of England, ultimately an unwillingness to extend credit in sufficient amounts to do the job. So, how do you respond to the necessity but not sufficiency?
Thank you so much for that question. And also just sort of reiterating the point on the conclusion. So I actually would almost completely agree with you. I would say that there is a very important aspect in which the way I think about the personal relation is sort of creating the space to have that difficult conversation. It doesn't necessarily guarantee that, but it will grease the wheels of difficult cooperation. And I think how I see it is in the context in which we then see these swaps to say Austria and the Reichsbank in the 1930s. The absence of the political relationship is sort of hedged by these additional concessions. So countries are maybe, less concerned about, or maybe would be more concerned about repayment or honoring the agreement. And so they want to at least make sure they're getting something else out of this agreement. And this is how we also see a lot of the swap lines to emerging markets, which is we want to help you. We have this affinity to do so. But at the same time, we do so with a bit of trepidation. And so in the current case, it's more the personal relation was stronger. But even in the historical case, there's the economic need and the interconnection between the banks obviously matters immensely. But to have that initial conversation and to try and do something is facilitated by the personal relation, but it can't do enough to overcome the need for conditions. That's how I would think about it. So it is necessary, but not sufficient.
English has also a question. Bill, do you want to ask the question directly? You are on mute if you want, but yeah, I will ask the question on your behalf. So Bill, English say very interesting. I wonder if this argument isn't also true domestically, how the board members get along and how they get along with the Reserve Bank presidents or the relationship with the Treasury and the Congress too.
So this is a really important question. And I think this is especially something that resonates a lot in even the 1930s cases, which is the relationship of the board can be one of the sources of constraints on the leader. In some cases, Benjamin Strong was seen as he was not seen as a strong man necessarily, but he was certainly much more influential and could, choose what New York's position was in a way that when Harrison came in, this was an opportunity for the board and the broader Reserve Bank presidents to constrain how the New York Fed acted at the international level. And in the current context as well, this is something that matters, which is how the board, the FOMC, and the New York Bank are positioned against each other, and who they are working with across these institutions will certainly matter in how they can play this continued role. So the way I think about where these factors come in is in whether the leader is influential in acting with not their own discretion, but with greater discretion to sidestep what the institution as a whole wants. And for example, there's many cases in which we see in the 1960s, the Swiss National Bank, the Federal Reserve, the Bank of France, all of the people who arranged a lot of the swap lines between these institutions were doing so against the wishes of the board of the main institution. And so in some cases, people that are more influential can more effectively sidestep those constraints, whereas others, depending on their position and their relationship with the institution more broadly, will be more constrained. For example, Harrison.
Eugene White, do you want to ask the questions you just typed into the Q&A?
Sure. So I'm a little concerned that you seem to use interchangeably the terms crisis and collapse. That is, I would think that if there's a good cooperation, you would be able to avoid a collapse by intervening in a crisis. For instance, there was about 2 years ago, the Fed intervened very vigorously and avoided a crisis and avoided a collapse. Whereas the 1930s, you might say, well, they had to do it. Of course, they had to do something. They had to come together.
Yeah.
So that's, that I think is an important distinction because there are some interventions which are timely and avoid a collapse. And I think that's important. And does that mean that in those situations there's better relations between bankers or what?
I hadn't actually thought about that distinction as much as perhaps I should. But it's a really valuable point. And I think on one hand, thinking through, the intervention to avoid a collapse, as we saw a couple of years ago, in that case, it was also very visible and it was announced. But there's many cases in which the intervention happens even before the crisis sort of shows its face. What I would respond to that is to see that the 2020 swap lines was an intervention to make sure that a crisis did not become a collapse, or same as in the 2008 crisis. But I have to say, I have to think about this distinction a little bit more, because I think the collapse is also a result of the lack of cooperation, whereas the crisis can be sort of managed in a more, over time way. So I'm sorry for not fully answering that question, but
And the other thing is the second part is, it seems to me that when you're talking about the financial collapse, there's that the U.S. acted to a certain degree as a hegemon. I mean, there's no one else you could do this. So it's not a party of equals. And whereas in the 20s and 30s, it's much more between equals, and that's a very big difference.
Absolutely. And I think so. The way I think about that is the US now certainly acts as a hegemon. But what struck me in the records, the FOMC meetings, the interviews, is that in some cases it took a little bit longer to get agreement on these swap lines, even from the ECB, even from Mervyn King. And so while the US is the one that has the capacity to play this role in these sort of, cooperative arrangements, they do need the consent of both parties, and this is where some actors have sort of pushed back. But certainly they have a lot more of the upper hand at this point, especially the more liquid environment, or the ability to expand balance sheets in this system vis-a-vis a gold standard, where they are just also naturally more constrained. So absolutely. But I think I can show, and I do show in the book, that there are opportunities for others to sort of push back on how the Fed plays its role, and negotiate those agreements as well.
We are close to the end, but before we end the formal session, let me ask you this: in the final chapter on the swap network during the 2007-8 crisis, you play, or you are induced by your interviewees to play a little bit with the counterfactual game. What if, right? What if instead of Ben Bernanke, Volcker was still at the Fed and had to deal with the crisis, or Sheila Bayer, right, the chair of the FDIC. So in the chapter on the 1931 crisis, you insist time and again on the severe disruption caused by the premature death of Benjamin Strong in the internal dynamics of the international central banking elite, and possibly also on Montagu Norman personally, right? So did you ask yourself, what if the Norman and Strong duo in very good shape was there to deal with the shock of 1931? So in a sense, would that made a difference? So I think that the question is, if the collapse of 1931 is the final outcome of a gold standard ideology, and these two guys were the archetypes of the gold standard ideology, what could they contribute to avert the disaster?
I think this is a great question, and it is something I thought about a lot. I didn't want to get into that possibility in a direct way in the book, because again, I have no sources to cite, but it was like the main counterfactual that I was asked about a lot, even while writing the PhD. And the way I think about it is twofold. One is, perhaps before the crisis became as bad as it did, there might have been some more cooperation between the two because of how they could continue their relationship. So we see that a lot of how these ad hoc credits were being extended throughout the 1920s slowed down, not with the Great Depression, but actually slowed down before, after Strong dies. So there might have been maybe a bit more continuation of those programs to just keep the system afloat. That's one agreement. The second is they might have collectively messed up because they were very much, bought into the gold standard idea. So I wouldn't necessarily say that the personal relationship always allows for the best result. It just allows for a cooperative result. So it could be that they cooperated in the wrong way, because again, the counterfactual that actually happened was the ultimate collapse. It's really hard to make that case that they would have done the right thing. But I think there certainly would have been a lot more space for some sort of interbank intervention. And that's because that's how Norman even wrote about it extensively, saying, this would have looked different if I were working with a different Fed, etc. But on that point, and this is why even in the 2008 counterfactual case, I talk about this, is I think a Volcker or a Sheila Bair Fed the reaction would have looked very different. It doesn't mean they would have just sat on their hands the whole time. They just would have done something else. And it, I'm sure, would have worked, but it may not have been the same sort of interventionist response, given like Sheila Bair has been very critical of a lot of the interventions, etc. So the leader on their own matters in sort of determining what the approach will be. Bernanke's expertise on the depression probably played a huge role in deciding that. So it's more about, I think cooperation in the 30s could have continued with Strong and Norman. I cannot guarantee it would have been the right approach, is my response, in a similar way to a different Fed would have done something different in '08, just perhaps not. We don't know if how it would have worked.
Great. We have to draw to a close the formal session, but before you leave, let me just remind you that we will have a new session of the seminar in 2 weeks' time on November 19. And Monique Reiske from Humboldt University, Berlin, will be talking about the political costs of debt deflation, agricultural crisis, and the rise of the Nazi Party. So we hope to see you again in 2 weeks' time here. And we can go on discussing for another 15 minutes if you want to stay with us.